Hey guys, it's Rob Jones with Deerwood Capital. I'm going to put together a series of videos that when you binge them and watch them together, hopefully the point is that this will be the only investment class, or course rather, that you will need. Because I'm going to make individual classes, put them together so that when you watch them, that's only the information you need to help you succeed with your investment goals. So for the first class, don't lose money. There's a full write-up at DeerwoodInvestments.com. It's about 6 pages, front and back, if you print it out. I'm trying to make this more appealing for a short 10-minute video, so I'm going to cram a lot of the figures and data and information in here. But you're only going to get the best of the best graphs, as shown by this loss aversion graph. So before we get started in talking about this psychological phenomenon, losses are what we need to prevent in order to make money. So said another way, the goal of investing, it's not a trick, it's to make money. But if you go out there just trying to make money and not watching the downside or your risk, then you're probably going to lose money more often than if you go and approach investing with not losing money, if that makes sense. It's nothing that I have created. This was done in algebra. When you try to solve a problem, you invert to get the solution. And the same way you would solve a maze where you start at the end and go to the beginning. It's a common solution or framework to a problem that was pioneered before me and introduced to me by investing by the greats that came before me. So hopefully this will resonate with some of you, and if not, feel free to shoot us some comments or questions or email us at info@deerwoodinvestments.com. We believe this is a very important rule and principle to investing, as noted by Warren Buffett. His first 2 rules of investing are 1, don't lose money, 2, don't forget rule number 1. Now that's very easy to say, but it's very hard to do. After all, investing is simple. That's simple to say, but it's not easy. It's very hard to do. If it was easy, everybody would be rich, and that's not the case. So hopefully a little bit of this information you can take away from me and apply to your own investing, or at least if somebody's doing it for you, ask them how their investment approach is. So the first 2 factors I'm going to talk about when it comes to loss and avoiding loss is being self-aware of why we beat ourselves up and why we take on losses. So what I'm talking about is this loss aversion. This is science, okay? It's psychological. Humans, we have been proven to feel pain worse than we feel the exact same amount of pleasure. For example, in this beautiful picture here, a pain of $50 from a loss could be felt 2 times as much as the level of pleasure you get from a $50 gain. All right? The next example I'm going to talk about is actually just straight mathematical. And a lot of people might not understand this because it doesn't make sense. So if you started with $100 and lost 50%, it would only take you 50% to make your $100 back, right? Wrong. Okay? It's easier to see. So on this graph here, we're going to start with point 1, $100. You lose 50%, and now you have $50. But to get back to $100 from that $50 starting point after point 1, we'll call it point 2, you will need a 100% increase. So said another way, you need a gain of 2 times or 100% to offset your initial loss of only 50%. So these 2 factors, when you put them together, it's very important to see that. Well, let me give you an example. I used to work at a brokerage firm, and they did a test, or a study rather, on all of their retail clients who traded for their own personal account. And these 2 factors came up over and over again, because with it, you would see people who invested and took a gain of, say, $5,000 and immediately closed. At the same time, if they lost $5,000, it hurt them so much that they would just hold on, maybe close their eyes and wish and pray and hope for things to turn around, when usually that doesn't work out. When your investment philosophy involves hoping and praying and really wishing and closing your eyes that things turn around and go up, there's a problem. So those two factors are huge contributors to those losses and people having bigger losses than they do their winners. Okay, so they lose more when they lose than when they win. Or they lose more when they lose than they win when they win. Or, let me get this right, they lose more when they're wrong, and then they win less when they're right. So they have to be right more often than they're wrong to offset those losses. Boom. I'm going to take that one. All right, so Rob, I get it. I'm going to invest. Actually, no, you know what? I don't get it yet. I'm not sold. Rule number 1, don't lose money. Okay, I'm going to sock my money away in my sock drawer, under my mattress, in a checking account that pays 1%, hopefully. Depending on your risk appetite, well, we won't even get there. But let's say you sock your money away underneath the bed in your sock drawer. You're going to have however much money you saved when you decide to use it in the future. Yes, but the problem is inflation, okay? This is the evil of money. Inflation, inflation, inflation. So when I explain it to my 8-year-old son, because I'm crazy and this is all I like to talk about, and he hears me talk about it and he's so nosy, he asks, "What are you talking about?" I tell him, well, when your grandpa or your great-grandpa used to go to the movies, it cost him 5 cents. Now it's like $20 just to go to the movies. This picture off Reddit does a great deal of justice. I mean, $20 in 1929 filled your shopping cart. In 2014, I guess when this picture was made, you could only buy a couple things, and that's especially true for now. So the government actually has a mandate to maintain 2% inflation every year. And that might not seem like a lot. In 1 year, $100 socked away would only buy you 98 cents worth in the following year. But inflation is nothing to be controlled. It's very hard for the government to. We've been in an area of low inflation, but if you look past, in the past decade, the past 100 years, you can see inflation as high as 20, 30% and as low as -%. So pulling up, 30 years, because I like to look at 30 years as a good investment horizon, we would go back to about 1990. And if you put $1 underneath your bed in 1990, then that same dollar would buy you about 51 cents worth of goods today. Okay? Now, compare that to if you invested that same dollar in the S&P 500 and reinvested the dividends in the S&P 500. If you don't know what the S&P 500 is, or you're still not comfortable with what's inside it, how to buy it, all that, I'll get into index funds in a later keynote. But basically, if you invested in this vehicle, the S&P 500, which is the 500 largest publicly traded American companies in the US, obviously redundant there, but anyways, in 1990, your dollar would turn into $12 today. So investing, you would have had $12 if you invested one from 1990. If you just stashed it away in your underwear drawer, you'd only have 51 cents. So that's very important to understand why you should be conservatively investing. And that's a conversation you need to have with yourself, with a professional, to figure out what the right sort of risk you have and need to be taking in your investment portfolio. The final most important loss, of course, is the loss of principal. Or say you invested this $1 in Radio Shack or Enron, okay? Some companies ultimately go bankrupt, and buying one individual stock is a lot more risky than owning 500. And I'll talk about what that's called, diversification, later. But the point being, there is the loss of principal. You could lose your dollar, and you need to be aware of when the time is right to invest. But since that's a loser's game, which I call timing the market, it's very hard to do. Not even most professionals can do it right. There's about 80% of professional money managers who can beat this S&P 500 by picking stocks. So that leaves you 20% chance to do it if you're a professional and that's your day job. So why I'm bringing up the loss of principal and the bear market loss is because if you know that you're in a bear market, which is typically the best time to invest, then I'm hoping that you have the conviction to understand it's not the best time to sell. Let's take a look at this bull and bear market trend. These are facts dived into by First Trust, and I pulled two very important quotes that I keep pretty much at my desk. And one is attributed to Mark Twain. He says, "History does not repeat itself, but it rhymes." And the other one's been attributed to Baron Rothschild. And he says, "The time to buy is when there's blood in the streets." Okay, so Mark Twain would look at this graph and he would say, okay, history is not repeating itself necessarily, but look how many times we have a bear market or a stock market crash. And a bear market is identified as from when the index closes at least 20% down from its previous high close through the lowest close reached after it has fallen 20% or more. So in layman's terms, after a stock market high, a recent high, and it falls 20%, that's known as a bear market. A bull market is the opposite of that, and bull markets have characteristics of a period that lasts 9.1 years with a cumulative total return of 476%. This compared to a bear market that only lasts about 1.4 years, but you lose nearly half your money in those situations, or 41%. And as you know now, based on the very artistic graph I showed you about 100% gain offsets a 50% loss, this 41% loss can really set you back if you're planning on retirement or planning on other financial goals. So, going back to our chart here, you can see that those are just averages. We've had years of 15 in a bull market, 12, 5, 2, 6.4. But again, I'm betting that if you can understand when we are in a bear market, hopefully you can find the courage to buy more stocks. Again, these are the best times to invest. Or even if you just know the characteristics and we're down 20%, then you have the will to be patient and do nothing and just hold, which is usually the best thing to do in these situations. Now, this just shows you the source where I got it from. It's First Trust. This goes back from 1926, and they did a study looking at the S&P 500, again through 2018. Here's a zoomed in rendition of it, and I don't know what else to say other than nobody can really time the markets. It's a very hard thing to do. Again, 20% of professionals have been able to beat the S&P 500 and be better than just investing in the S&P 500. That I'm going to get into in the next class, what the S&P 500 is, what's the best way to invest in it, why I think in the long term it will go up. As you can see here, from 1990 to 2018 till January, actually 2019, this trend goes to. It'll be more valuable in the long term, but in the short term, I mean, we are going to see history repeat itself, and what our goal is to limit our loss when other people are losing, or if you could, gain in situations when you recognize we're in a bear market and you can put your money to work and buy more with the same amount of dollars. Said another way, if you're investing for the next 10, 15, 20, 30 years, you should align yourself to want stocks to fall, the price of stocks to fall. Why is that? That's because you get to buy more with your money. If you're saving every month or every quarter, then the cheaper stocks get, the more you get to buy with the same amount of money. I like it. I say this to clients. I say, if you like pizza or cheeseburgers and you're going to eat cheeseburgers for the rest of your life, or pizza, what have you, and the price of pizza or cheeseburgers falls, then you're excited. And you should act the same exact way depending on where you are in life when stocks fall. So that's what I got for you. Again, I'm Rob Jones with Deerwood Capital. Check us out on social media at DWCmoney and DeerwoodInvestments.com for more information about what we just went over. Thanks. Bye.